Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Flutter Entertainment stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Flutter Entertainment is an online gambling company. It operates under various brands including BetEasy, Betfair, FanDuel, FoxBet, Full Tilt Poker, Paddy Power, PokerStars, SkyBet, and TVG Network. The company is headquartered in Dublin, Ireland, and was founded in 2016. The ticker trades on the OTC, London Stock Exchange, Irish Stock Exchange, Deutsche Börse, and the BATS. Let's get started with the model. This is a large cap company, 21 billion market cap. They're trading at $120 a share, and they have 176 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. It's good to see they have positive free cash flow each year, peaking in 2020 at close to $1 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's positive in 18 and 19, negative in 2020 and 2021. Revenue is the sales for the company, and that goes up quite a bit from $2.4 billion to $7.6 billion. This is the company's income statement. The top line is the revenue, the sales. All their financials are in British pounds, but on my Excel spreadsheet, I converted the numbers to US dollars, since we're looking at the ticker that trades in the US. So they generated over 6 billion pounds of revenue in 2021. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And you can see that went up quite a bit from 1.4 billion to 3.7 billion. Below that is our operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. And that was negative in 2020, positive in the other years. It looks like they're adding a lot of debt because they only paid $4 million of interest on their debt in 2018. Now it's over $200 million. And they also had $21 million of financing costs. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income. Even though their revenue is increasing, their net income is getting worse. This sometimes happens with companies that are trying to grow really fast. They're spending lots of money to grow and scale their business. The idea is it leads to greater growth in the future. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They spent nearly $300 million in CapEx. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they are cash flow positive every year. They had the most in 2020 at close to 800 million pounds. In 2021, it's 400 million pounds. In 2020, they raised 2 billion pounds by issuing common stock. And it looks like they used half that money to pay down debt because they paid down 1.9 billion pounds. Issued 950 million. They added about 400 million pounds of debt in 2021. As long as a company is generating positive cash flow where they can afford to pay the interest on their debt, then using debt to grow your business is fine. But if they had negative operating cash flow and they were issuing debt, I would consider this a problem. Let's look at the capital structure. 13 billion of equity, 4.8 billion of debt. They're 73% equity, 27% debt. And this is their capital structure since 2015. So you can see their equity balance has gone up quite a bit. Their debt has increased a little as well, but not nearly as much as their equity. And they've been growing their cash balance. That's the green line down here. So the capital structure looks pretty strong. I gave them the middle whack on Finbox, 9.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 21 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $18 billion. We divide that by 176 million shares. And we get a calculated stock price of 105. They're trading at 120, so they're trading at a 15% premium. It's a sell according to the model. Their revenue target in 2024 is 8.6 billion pounds, which is equivalent to 10.8 billion US dollars. Their target in 2023 is $9.8 billion, In 2022, it's 8.4 billion. And I continued this growth into 2025 and I got 11.8 billion. That's how I got the future revenue estimates. They convert on average 12% of their revenue into free cash flow. So I multiplied their future revenue estimates by 12%. That's how I got their future free cash flows. The website Simply Wall Street is a lot higher than me. They're at 276. They're saying the stock is 58% undervalued. They have a beta of 0.84, so the stock moves a little less than the market. It's not too volatile. It's gone down 37% in the past 52 weeks, while the S&P is down 3%. The 52-week low is 96, the high is 223. And the stock is trading between its 50-day and 200-day moving average. Only about 1,500 shares are traded each day on this stock. Of the 176 million shares outstanding, 152 million are on float, and 58% are held by institutions. If you put $10,000 into this company when they started trading, you'd be at $5,300 today. That's a 47% loss. This is where the stock has been trading the past year. It was trading over $200 for a few months, but the stock price has been cut in half. It did fall to below $100, but that does appear to be its resistance point, since it has come up since then. The CEO's annual salary is £923,000, which is over $1 million US, and their total compensation package is over £8 million. In the past 12 months, there's been only insider buying, no selling. That's a good sign. It looks like all these people bought at a pretty good point. The stock is trading at a higher price now than all these buy prices. 46% of the companies held by the general public, 41% by institutions, 10% by hedge funds, and 3% by private companies. The company has been doing lots of acquisitions over the years, so their employee count has grown quite a bit. They're currently up to almost 17,000 people. The biggest shareholder is Capital Research at 14%, then Caledonia, BlackRock, Vanguard, and Massachusetts Financial Services. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a pretty good price of sales of 2.8. That's stock price over sales per share. That's the same as the market median. Their price to book is 1.6. That's stock price over book value per share. But their tangible price to book is negative since they have negative tangible equity. And their price to free cash flow is 43. That's stock price over free cash flow per share. Their current ratio is 0.9. Their current assets are 2.5 billion. Current liabilities 2.6 billion. Same thing with the quick ratio, 0.9, since they have no inventory. In 2021, they generated $493 million of cash flow, and they have negative $141 million of working capital. So it seems like they have enough funding to get through the next 12 months without adding any more debt. The best way to look at ratios is to compare them to companies in the same industry. There are 17 companies in the same industry as Flutter, and if Flutter has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They invest the most in CapEx of all the companies. They have a good debt to equity ratio. They do generate positive free cash flow. The average is only 77 million. They're the largest company on this list at 21 billion market cap. They do have a good price to book. We cannot look at their price to earnings. Their price to free cash flow is worse than average, but at least they have positive free cash flow. DraftKings is negative. Their price to sales equals average. They generate the most revenue of all the companies, and they have a negative ROA and ROE since they have negative net income. So to summarize, I have them trading at a 15% premium. So many people enjoy gambling, and now it's more convenient than ever because we could do it in our own homes. And it seems like more and more states and countries are legalizing online gambling, which really helps companies like this. I rank their free cash flow as 5 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.